Hey everyone, welcome back to another edition of Super Prime UK with your MJ Group Super Prime Valuation Specialist, myself, Rob Cohen.
Myself, James Wild.
Super excited today. We are show number 2 of the EVA quarterly update. And today we have our special guest from Kenstone, Martinus Kurth, who will be telling us everything that's been happening in the last quarter in the Germany real estate market. Just before I intro Martinus, just to remind you all, EVA is the European Valuers Alliance, pan-European wide network of 12 leading valuation companies spanning 15 countries with over 750 staff, with 40 offices, and we are providing you quarterly updates using the latest intel and data, going to a different country and different market each time. And today we're in Germany with Martinus Kurth from Kenstone. Welcome, Martinus.
Well, thank you, Rob. Thank you, James, and all the best greetings from Berlin. I give you a short overview about who Kenstone is for those who maybe don't know us. Kenstone is one of the leading German valuation companies. We have 90 valuers all over Germany in the eight big major cities. And we're doing something like about 80 billion market volume a year, 20,000 valuations, and working for all asset classes and for financial industry as well as for investors, insurance companies, whoever has a request and a wish to get a good commercial real estate valuation.
Great, thank you, Martinus. And obviously we just had Expo Real last week in Munich, which I believe you attended. So I was wondering if you could tell us a little bit more about the sort of general mood and the market sentiments across the German market.
Yeah, that's actually a very perfect timing. Last week was the Expo Real, and it was, I would say, it was the first time since more than a decade that it was the beginning of a time of change. I would not say there was a bad mood, but I would say everybody is waiting a little bit. Supply and demand have not yet leveled out each other. So those who want to buy say, no, with this high interest levels that we have, why should I buy now? Let's wait half a year or another 9 months. I can get the deal cheaper. And those who want to sell say, why should we reduce our prices? Because we still have a very good rental level here and still having good incomes on our properties. So there's no need for that. So everybody's waiting a little bit for each other. And this is the situation that we have. That's not good for transaction market, because if there's such a situation, we don't see much transactions. And we also, in terms of financing, of commercial real estate financing, we see that's really also difficult for the banks now to get their money placed on the market, because simply the request is quite low at the moment. But anyway, it was a good mood. It was very good to see the whole industry in Munich, and we are far away from former times, but like 2008. But we are on a process of changing time now.
Yeah, thank you, Martinus. I think that German market seems to be mimicking the UK almost at the moment, with going through the period of inflation, rising interest rates, and people are a little bit cautious, and it's very much a wait and see attitude. Like you say, economically, we know across Europe, the UK, and also sort of global economies, it's been a tough year in 2022 so far. Obviously, Europe's largest economy, Germany, is also sort of slightly faltered in 2022, whilst inflation has been an issue with yourselves, running at about 10%. I believe it's recently gone up to there, with anticipated peaks around 13%. Much of Europe has had a cost of living crisis, whereby the wage increases just haven't kept pace with inflation. And what's been the main impact of that so far in Germany, Martinus?
Yeah, it's still the same situation that I think has that takes place in a lot of countries in Europe. We have high living costs. And in Germany, we have the situation that, of course, the energy supply side is difficult, because we were very much dependent on Russian gas. And the story is over now, simply. And that gives a very much increase on energy costs. And this is something that really worries the people in Germany, and where we see the inflation mostly comes from. We have support from sides of the state. I can talk later about how much it is and what the state is doing. But there is, of course, a high nervosity in Germany, especially regarding this winter, because the energy question is still not answered. We have our gas reservoirs are now filled with 95%, which is good, but we still don't know what the situation in winter will be like. Although we are going to face a recession. Yesterday, the German government said that we're going to expect a recession in next year with a GDP of minus 0.4. And maybe this year we have something like 1.5 GDP, which is still positive, but we're going to face a recession, that's clear. And also that will take place in the first 2 quarters of next year. And but what we can say on the positive side, we're looking always optimistic to the future. We still have a very strong labor market. We have a very low unemployment rate. It's 5.3. And if you put out the number of Ukrainian refugees, which are now the first quarter in this statistics, it's something like 4.9, which is still stable. And we have still industries who are looking for people. So it has not reached, it has not reached the labor market, and I don't think it will reach the labor market, because if you see on the age structure of Germany, there are a lot of people like my age going up to retire within the next 10, 12 years, which is over 10 million people. And Germany now has about 83 million inhabitants. So there's a lot of movement then into retirement. So the labor market still is quite stable. And this is why we see, to my mind, a very reasonable demand from sides of the trade unions regarding reacting on this inflation level. What we see is right now that even if we have about 10% inflation, the demands of the trade unions are, let's say, something about 7 and 8%, and they get 5, which means 5% less in the portemonnaires of the people, but still on a very high level of employment.
Yeah, I think that's comparative with the UK, Rob, running around about sort of 4.5 to 5% unemployment here in the UK. I think where the UK has struggled more so is within their sort of tight labour market. We obviously have had Brexit over the course of the last sort of 5 or 6 years here, which has been a very constrained labour market. And obviously in the past 12 months or so, Rob, we've had more strikes in the UK from some of the trade unions, which have put pressure on a number of sectors here. So sort of the plights of the cost of living crisis just explained more there. Thank you. Germany obviously part of the Euro and the European Central Bank, and obviously it's the ECB which sets the interest rates there. In absence of the ability for Germany to control their own interest rates, Martinus, has there been any other fiscal measures from the government introduced to try and dampen inflation at all?
The interesting thing is there are a lot of measures that the government is doing, but those is mostly supporting, of course, the people due to this high inflation. So it's a package about, I think, 280 billion euros that has been spread all over the country. Actually, 3 parcels. And the last one, the third parcel, was just announced last week with a volume of 200 billion euros, which is really a lot. So they're supporting families, they're supporting those who have gas stations at home. They're doing a lot to get the consequences of this high cost situation down. But of course, this means that another money comes into the whole system. So in terms of, is it really stopping inflation? No, it will just harm the situation and makes it a little bit easier for those who have to pay these high bills at the end. On the fiscal side, the state tries to reduce taxes, which is possible at certain points, but not too much. So there are some measures that they are doing. The whole package is interesting, but again, the money comes into the market. It supports those who have difficulties. And when we see that today, the German Bundesbank said that 54% of the Germans are now saving less or no euro every month. that shows the impact that we have on the inflation side, and that will, with the consequence, of course, show if the people don't have much money, that they cannot consume, and we see all the consequences then following up.
Yeah, no, thank you, Martinus. Obviously, the UK has had a new Prime Minister fairly recently with a new mini budget, and they've adopted a quite a strong growth model here in the UK. It seems like there's a similar model in Germany, but maybe to a slightly lesser extreme there in terms of some of their growth initiatives which they're putting into the economy. Speaking of the government structure, it's been around 12 months since Angela Merkel stepped down as Chancellor. I think it was Germany's longest standing Chancellor, with the new coalition government coming in. They've put in some growth measures you were referring to there, just to rejuvenate the economy and try and sort of stretch that growth to try and possibly prevent a recession, Martinus. But it feels like Q4 here in the UK, the UK might tip into recession also. In terms of the real estate markets, what's been the strongest and weakest sectors so far in 2022, Martinus?
Strongest sector clearly still is the residential market. If you take into account that we have a very low, in comparison to the UK and other European countries, a very low quote of owners in Germany. So it's really a rental market. And this is part of our commercial real estate system, and also of commercial real estate valuation. It belongs to a residential market, belongs to it. This is the strongest market. Remember, we need to have 400,000 new apartments a year. And we built 200,000, which means we have a very serious problem here in the major A cities, but also in the B cities, to find room which is payable, which is affordable to families. This is really a big issue. Yesterday in the German Kanzleramt with Olaf Scholz, there was a big summit of the whole industry. How can we solve this problem? And of course, that means that we are still on a very high level of residential rents and still on a very high level of prices. And I do not see, even if the interest rate situation is like that we have right now with something like 3.9% interest rate for a 10-year loan, I don't see any prices falling in this part. So therefore, a very strong market here. Weak is, I would say, the clear weak asset classes are retail, hotellery. This is where we see the consequences of first the inflation situation. If there's less money within the people, they cannot spend. So this is one thing. And I think the hotellery as a whole just suffers still from the Corona time. Everybody looks a little bit on the office side. What's going to happen with office? Quite a stable, also in the figures that we have right now, a stable segment, but everybody is going to expect that the request for office space will slightly go down. We have to see how much, but home office is also in Germany a very, very new development, and it's very much appreciated. For example, our company, we have 70% of our people are at home office.
Yeah, no, thank you for that, Martinus. It's interesting just in terms of your targets, in terms of delivery of new homes. In the UK, our target is around 300,000 units per year, and we're only building 180 to 200,000 per year, so roughly the same amount of homes we're delivering here. Obviously, the pandemic put a lot of strain on that sector, and the UK's Rob has experienced really double-digit growth for a long period now. So it's just starting to slow here, what we're seeing against most markets. Obviously, in terms of the retail, restaurant, hotelier sectors, it's going to be a very tough winter across a number of those sections. I notice, obviously, in Germany at this particular time, it might be quite a strong tourism month for yourselves. I think Oktoberfest is on at the moment. So there's probably a lot more tourists in this particular month than some of the others, although that's going to reduce towards the end of the month once the festival finishes. Moving on to residential, Rob and Martinus. with a real focus. Over the course of the last couple of years, prime central London here in the sort of 10 million plus bracket, it's performed extremely strongly with sort of growth 15 to 20%, Rob, which we've seen. Has this been a similar trend in Germany at that sort of peak super prime level? Has there been sort of high levels of growth, activity in the market?
Yeah, it is. Germany is a bit organized different than the UK. So in the UK, you focus very much on London. In Germany, we have more cities where other industries are. So this is a little bit more, it's a wider spread. But if we take special the A cities, which is Berlin, which is Munich, which is Hamburg, which is Frankfurt, these are the big four for office. These are the big four also for residential. But speaking of the office market, these four cities are the one who's doing a very much part of the turnover that we have here in the market. And the first half actually of 22 was quite good. So if we take the first quarter in commercial real estate investment, especially in the office market, we've seen nearly about 20 billion euros were in this segment in the first quarter, which is an absolutely record, even if we face that the Russian crisis or Ukraine crisis was going to start then. And if we see where these turnover was made, it was most of the was done in office. For example, in Berlin, we have the Sony Center in Berlin, 680 million, Sky Ashbourne, 113 million, Berlin Techno Campus, 400 million. These are really figures that shows that the office market itself is in quite a good shape. And all these properties, all these deals were really core.
Yeah, no, thank you, Martinus. I think that goes some way to answer my next question, actually, whereby in the UK we've seen a number of best-in-class and trophy assets trade, both on the residential, Rob. We've had the record high residential property trading for 200 million in 2020, and a number of office buildings, some real sort of trophy assets there trading. And like you're alluding to there, Martinus, I think that's been a similar story in Germany.
Yeah, it is. When we refer to the figures that we are going to publish next week with the new EVA market report, you can see how the yields in the office markets are and how these strong figures really represent or can be underlined by the market report. We still have a very, very low vacancy rate within office. And what we maybe see in the next month is, when you're going to invest, you try to get in the A sections, you go to the core market. Referring to the age of the office space that we have, 64% of the German office space is older than 1978, and only 5% is younger than 2009. So these are the core assets where also investment funds, also in terms of the ESG theme, are focusing on. The interesting question is, when the market changes, what's going to happen with the 64 and what can be done there? So especially also in terms of energetic renewable necessities, these old buildings will simply disappear, and then we're going to see what's been which investment volume will take exactly place there.
Thank you, Martinus. So obviously over the last couple of years, we've seen the emergence of more hybrid working across the UK and across many major cities. Has there been any lasting changes of that in terms of the sort of office attendance? I know a lot of companies in the UK have made real conscious efforts to really attract employees back to the office.
Yeah. One thing is, of course, home office is, it's a very nice and it's does save, of course, space. But taking into account what I said before to the German labor market, we have to attract people to come to work with the companies. So we as Kenstone have to attract young valuers to find their way to us. Therefore, we have to invest, to my mind, much more into each square meter of a space, because we want to have a well-being situation. We want to have a good welcome situation. We need more space for cooperation, more space for team meetings and something like that. I think that the request might slightly go down. We will see that there are certain certain square meters that are not anymore needed, but the quality of the space is now the question. So if we want to attract people to come to a company, we have to offer them a very good office situation and a very good situation where they can meet with the team and interact with the team. This is one of the consequences, I think, also of the pandemic situation. Up to a certain moment, you lose the people when they're always at home office. You have to bring them back into the office, and you have to get them seeing the office as a very attractive point. So I think we have to invest more money into the square meter of office space.
Yeah, completely agree with that. In terms of that training and bringing people through, new valuers, younger valuers, that on-the-job training is really you can't really replace that with people working from home. And as we call it in the UK, Rob, that Grade A office space is the real sort of in-demand space, and that sort of more sort of Grade B or C more lingers on the market with less take-up of that space. I think that ties in slightly, Martinus, my final question, just in regards to the we spun it as the race for space over here, with people migrating out of cities for more space during the pandemic. Is that something, a trend that's continued, and has it affected the labour market at all?
It's an effect on the labor market on the one side, but also on the situation that we have here in the A and B cities that I said before. Try to find an apartment in Berlin downtown. We will have fun with that. So there is, from two sides, the necessity to go to the suburbs and go to the circles around the cities, simply because you don't find affordable, payable place in the city, and therefore you're forced to go out. And you can go out because if you just go 1 time or 2 times a week in the office downtown Berlin, that means you're 3 days out wherever you live. So the flexibility here is given, and therefore these two aspects lead to the point that we have more movement downtown out of the cities that we had in the last 10 years, where the trend was exactly the opposite. People went downtown into the cities and wanted to have city life and everything like that. Especially the founder scene in Berlin was very much focused on very special districts of Berlin. They were absolutely in. But now we see the absolutely opposite. The people getting out of the city. It's affordable to buy there. It's good to live there. You have good living conditions, and you just to go 1 or 2 times to your office. It's perfect.
Thank you very much.
I think it's amazing, James, that we did our first EVA quarterly update in France, and we noticed how the trends in France were so similar to what we face here in the UK. And now, having listened to Martinus and all of his responses and the data and the intel that he's sharing with us with what's happening on the ground in Germany, is again so similar. And does that mean that globalization, especially at a European level, has really taken place, and all of the challenges that we're facing in all sectors is so similar now?
Definitely. I think a lot of countries in the EU and in Europe are struggling with the same challenges. We've all got that cost of living crisis. Obviously, coming into winter now, there's going to be an energy crisis as well. There's the UK is more affected by it, but we've also got the constrained labour market over here. A lot of the European countries follow suit with what America does in terms of their interest rates as well. And obviously we've got the sort of coin term of stagflation in the UK, but also a lot of other countries whereby they have slow growth but the high inflation. So I think everyone is really in a similar boat at the moment, and obviously just trying to, a lot of European countries certainly trying to avoid that recession at the moment.
Martinus, you said at the beginning about change and the sentiment and feeling at Expo Real. And I was just interested because, like you, I'm 3 decades in the industry, and it does feel like we've been here before. At the same time, like you've clearly mentioned in the last 20 minutes, you've clearly shown us that the fundamentals of commercial and residential real estate and labour demands are strong. So maybe the position is slightly different to those historical positions. What are your thoughts on that, Martinus?
When we went to Expo, we really were kind of thinking, remember 2008, just after the Lehman disaster, the Expo took place, I think, 3 or 4 weeks later, and it was really like the waves, the shock waves were in the rooms, were in the halls. This situation is not the case. We have a functioning financial market. We have banks operating extremely professional. We have back office in the banks who exactly know what to do for the situation, and they are prepared now because they've seen it before and they have done their homework to go for a situation like this and to prepare. We have trust within the banks. That was a big difference in the last crisis, 2008, where the banks did not trust each other. They did not lend money to each other. All this financial sector is absolutely intact. And if we see the reaction that we're taking, that we're seeing on the real estate market, like finding a new price level, it's so normal. So I don't see any risks coming from that side. This is a time of change because we are used since 12 years that the market just knows one direction, that goes up. And now we have to learn, okay, we have reached a certain point and now the situation changes. If we take into account the interest rates, let's say 3 or 4%, we were in times in the beginning of the 80s where we had 11, 12, 14% interest rates. So I think the market needs a certain time to find a new level. I would say something like 6 to 12 months. And then we are on a new level, and the market will react absolutely in line with that. And there's nothing really to be shocked about. It's a normal change, and I would say, I don't know if the English word is right. It's a peaceful change. That's the way it is.
Last one for today, Martinus. On last week's show, James and I talked about 15% interest rates 30 years ago, the UK leaving the ERM, the exchange rate mechanism, the pound crashed against the dollar, and we're seeing similar uncertainty here. And I said to James, James, the economy now can go 3 ways. There can be a technical recession, which is 2 consecutive minus GDPs. There could be a medium-term recession, 12 to 18 months of a downward market, or there could be a deep long-term recession depending on what happens in many variables, macroeconomic positions across the world. So what is your viewpoint on those 3 scenarios?
I think that that we have a short-term recession. So we will recover from it in the second half of next year. This is my guess. And I think we have found then also the level from which we can start new, from which we have this restart button. If nothing else happens, what we maybe do not know. This is a problem that I think all face at the moment. We don't know exactly what's going to happen on the political side, what's going to happen in Ukraine. But at the moment, as I think that the markets react totally normal on the situations, I would say let's take 12-month time and then we come to an end.
Brilliant. Thank you so much, Martinus. Incredible insight. Everyone watching, if you don't have that data or you want that data, please subscribe. Please lock in. Make sure you get the EVA third quarter data in Intel. Great insight, great information, first to market. That's what EVA produces. That's what this show is producing for you. Every quarter, updates from a different country, a different partner of EVA, and that's what we've brought to you today. Thank you so much, Martinus. Amazing insight, amazing intel, and great experience and knowledge from Germany. Really appreciate you on the show and look forward to catching up soon. Thanks, Martinus.
Thank you. Thank Rob. Thank James. Thank you all. It was a pleasure and an honor to be here on your show.
Wonderful.
Thank you very much, Martinus. Thanks, everyone.
Thank you.